It's our great pleasure to welcome to the show Erik from your weekend reading, the YWR newsletter. Erik, thanks for joining us.
Kevin, good to see you again.
It's looking forward to it. And he wore a tie, folks. For those that are listening, he's dressing up for the occasion.
Big stuff coming.
He must have thought he was on a different podcast. So, Erik, last time you were on the show, I was just looking it up before we started this. One of your picks was Barclays. And I remember at the time thinking to myself, oh, that's a bold call. Everyone hates Europe. Everyone hates the banks. It was just a brilliant call, like brilliant, buddy. Like it was just absolutely fantastic. It's the kind of things that I've learned from you, that you give these outside the box calls that just seem preposterous and then end up working. And that is a perfect example. So let's just start off with Barclays. Walk us through what you saw back then. Are you still in it? Do you still think that there's more to go? Just kind of give us any update on that story.
Yeah. The background, Kevin, is I used to be a banks analyst, so it was in my wheelhouse to know these banks well, anyways. But what I saw was a bank sector which had headwinds for 10 years, which I think we all they performed so badly for so long, and the problems persisted much longer than anyone thought, to the point where we all kind of forgot about them.
Right.
But what I noticed in 2022 and what woke me up was, I was like, all the things we hated, all the headwinds are flipping to tailwinds. Headwind number one was the capital ratios. European banks were they were having to raise their tier one ratio from 6% to 14%. Problem number two was the 0% interest rates.
Right.
All of a sudden, and this is something that affect all banks around the world, but we had these higher interest rates. And the third one was lack of growth. And that was constrained by number one, which was just these regulators. Banks are in the doghouse. We don't want you to grow. We want you to build capital and never have that problem ever happen again.
Right.
And so we had banks at 0.3 times book. And I saw that actually with interest rates rising, they were going to finally be able to widen out these net interest margins. And so profitability was going to improve. And I had this non-consensus view that the banks were not going to pass on much of this to the depositors. So you were actually going to get quite a bit of profitability. And also that other non-consensus view was that everyone thought, oh, well, if interest rates go up, you're going to have a economic recession and there'll be all these credit costs, and whatever you make on the net interest margin, you're going to give it away in asset quality. And I said, I don't think so. These banks have not lent since 2007. If you look at the assets, they've been flat as a pancake or slightly down. Banks don't usually have asset problems when they've been sitting around on the same loans for 10 years. It's when it's when you've had a bubble and you're growing 15% and housing's going crazy and you're lending and nothing can go wrong. That's when you have an asset quality bubble. I was like, there's not going to be any asset quality problems. So that is what we've now played out from 2022 through 2024. And earnings have gone up substantially, revisions have gone up, but we're at kind of an interesting stage now. And why I think it's kind of interesting from a macro standpoint, and why I think there's actually more to go from the trade.
Okay.
I was thinking, and this is kind of interesting, just human psychology. I was thinking, okay, these banks are going to make more money than they expect. These CEOs are bearish on Europe. They don't see how much the profitability is going to improve. But I predict by 2024, they'll have made good money in 23 or 22, and then in 23. And when they get to 24 and these profits are rolling in, they will start to grow the loan book. They will start to regain their confidence and wake up, start to stop talking so defensively. But that actually didn't happen in 2024. And it's actually taken, it's almost like it's a psychology around actually finally closing the books, putting the year in the bank. And I'm actually starting to see that now, where these banks are sitting around with 15, 16% tier one ratios, ROEs expanding, asset quality fine, even extra provisions tucked away. And they're going, you know what? And they've been buying back shares, and investors are kind of going, okay, where's the growth? And so I think now we're actually, and you see it, and it's kind of dovetailing with this more positive view on Europe about fiscal stimulus in Germany, and Europe needs to grow again. And I thought always in the background, everyone's always been super bearish on Europe, and I get it, but I thought this is very interesting potential energy that the entire banking sector is stacked high with capital that they have nothing to do with. If they ever wanted to, right?
Yeah.
They if they ever got those animal spirits, they can lend their brains out. And if the regulator, if there was a kind of a top-down view that we want you to lend, and so I think that's starting to happen. I mean, we're having this kind of, political view, the zeitgeist that we want Europe to grow, and now the banks. It took a little longer than I expected, but the CEOs of the banks now are opening up about growing mortgages, growing corporate loans, and so um, I think we're kind of getting into this next leg of the trade, which is kind of a re-rating.
Right.
The earnings have gone up. We've gone from 4 or 5 times to 6, 7, and I'm like, okay. And I, so early that I'm like, okay, this trade's done. But I'm like, you know what? Actually, maybe this is where we go from PEs of 6, 7 to 8, 9, 10, 11,
Right.
and we get commission growth and loan growth, and the story kind of goes on to this
Because
semi-growth.
the other thing about the Europe is that their economy is much more dependent on bank loan growth, if I'm not mistaken, right?
Yes,
Versus the
yes,
US. So if
yes,
they want to grow, don't they have to almost by definition have their banks
yeah.
doing better?
Yes, yes. You're right. It's much less capital markets intensive in
Right.
terms of securitization and corporate bonds. Yeah, the banks really, it's very bank centric. So
Oh,
it all
okay. So
it's kind of positive. So I think there's more to go is the answer.
okay, so more to go. You're still on that trade, even though your first inclination was that maybe you should ring the register, but now you're thinking might keep going. Let's talk about since you're a bank analyst, and since one of the big things that is um, was kind of the bullish impetus for the kind of Trump deregulation theme that everyone got so excited about in late 2024. That was kind of the whole idea, right? That was why Stanley Druckenmiller said this is the most business friendly administration I've seen in decades. Why these people thought that they're going to come in, they're going to deregulate the banks, we're going to have all this private loan growth, and the government's going to be cut down. It's going to be nirvana. It's going to be this great thing. It turns out that it hasn't been that way. It's been, with the on again, off again, so the tariffs has been ugly. What do you think about the U.S. side of the bank equation? Like, are you worried about it, or do you think that bullish story might reemerge? I'd love to hear your views on U.S. banks.
Um, the U.S. banks have been a bit not not necessarily not aggressive, but moderately growing more than the Europeans were. So they're in this middle ground. And as we know, what really took up the lending and has been almost this alternative space, right?
Right.
We've had banks growing, but somewhat restrained, and you've had this private credit kind of step in and take a little bit of market share from the banks. Not that lending has been out, going crazy in the U.S., but you've had this new player come into the market, and so I'm not I'm not that excited about the U.S. banks. They trade at much higher valuations than European banks, more like in the 11, 12 times PEs versus 6 to 7 in Europe. So, but what I'm more concerned about with the U.S. is I'm much more concerned about the economy in the U.S. than I am about Europe, and that is that I think we have this. I mean, it starts with the fact that I have this kind of non-consensus view that interest rates are going to go higher in the U.S.
Okay,
That,
well, tell us why. Do that. Let's start with that.
okay, because that's the whole, that's
Well,
where I'm
it's
totally off the rails versus everybody else. I think
no.
this.
But listen,
Not
last time
everybody,
you were
but
off, the rails, it paid to listen. So let's listen to your theory.
Okay, so I have this view that the 10-year goes to 6%, and basically it is that if you were to just take the name off these statistics around the deficit, around the trade balance, you would think this was an emerging market. This is what happens. I mean, when you're running 6% trade deficits, when you're having record trade deficits, you would think this was Turkey with the types of numbers. But what has offset this, and we've kind of become a little bit complacent about it, I think, or very complacent about it, is the capital inflows. So this current account deficit is being offset by very strong asset flows into the U.S. Asset inflows into U.S. bonds, into real estate, into private equity, into the stock market, the whole world parking. And very, very stable currency, right? So all this money coming in, and it's paper. It's offset these very high level of borrowing and high level of imports. And so I'm like, that is very thin ice to be on. And on the other hand, I think U.S. assets look the most unattractive they have ever, not maybe ever, but close to ever been. Yep. You have a stock market almost at the 2001 PE ratios. You have a 10-year bond at 4.2% with 3% inflation. And I guess people would say, oh, inflation is going to 2%, but fine, but it's not. And it's right. And so you have almost no term. Okay, we could find the number is 3 and there's no term premium. So you're getting paid almost nothing for that 10-year bond. And you have a Fed that's losing credibility, that cut rates when now it realizes it probably shouldn't have. And then let's layer on top of that credit spreads are almost nothing. So there's no juice in the credit. Your credit, you're very much, if you're in corporate bonds, you're very sensitive to what that 10-year does. And so all these things can unwind on you. The 10-year can go up. The credit spreads can widen. The stock market can come down. And on top of that, you have a very expensive currency. So you could lose to a foreign investor. You could lose on all of those things. And then you start to see other things in the world start. And at the other time, you have this massive record discrepancy in valuation between the US and the rest of the world. Right. So as things start to go wrong in areas, the flywheel starts to turn and you start to not lose money in the US, you see, how much the opportunities elsewhere. And so, even just things like savings from the Japanese, right? All of a sudden you get, I think it's almost 2% on the Japanese 10-year. And the currency's at 140 yen to the dollar. It's very cheap. And so these savings pools, I think these savings pools, I think money is we're not going to have such generous inflows into the US.
Yeah.
And I don't think Doge is going to make one dent in the amount of deficits that we're running. So I think we're probably just going to have weakening currency. It's basically an EM type story. The currency starts to weaken, you get capital outflows, and the bond yields go up. And we're not used to it, but I think that's the setup.
All right. And listen, it's a theme that I've heard a lot of people say. I'm very sympathetic to it. I think that where your viewpoint might be a little bit different is a lot of other people are focusing on the stock market being overvalued, and they think that that's going to be where the money flows out of. You seem to think that the potential problem could be in the bond market first. And it'd be like the bond market will cause the stock market to go down. It will cause the economy to run into trouble. Would that be fair to say?
You know what? I'll say, I think they're interrelated to some. Yep. So I'll give a partially. I mean, one is if money starts coming out of the market, it weakens the currency, and the 10-year doesn't like that. But also, I think another thing is, I think there's a much stronger underlying inflation situation than I think the consensus view would be, if the market's going to be weak, we should have this flight to safety, and the 10-year is going to rally like it always does, and the dollar will be strong. And so I think this is actually, we're in this different environment that we've been in since 2022, and we're staircasing higher up in yields, and the market going down is not going to make the 10-year rally, which it kind of already hasn't. We already it's like that dog that, what's the dog that didn't bark,
Yeah.
It's like when you see the market come off 10% and the 10-year isn't even really reacting like you thought, that should be a yellow flag for you that there may be a different dynamic creeping into the mix. And on the inflation, energy has been, we have just also on that dog that doesn't bark thing, we have 3% inflation while energy has been super weak. And the dollar's been super strong, and yet we have this. Why is the three not become two? As all these experts from the Fed that have PhDs in economics, and they're so sure that we were going to have 2% inflation by now, and we don't. What are they getting wrong? And I think that there is really an affordability problem for families in the U.S. and in Canada. I remember you were talking about Canadian housing, and the problem is the housing has gotten so expensive that I know you say, well, if I own my house and I have my long-term mortgage, it doesn't really affect me that the housing has gone up 40% or whatever.
Right.
But what happens is slowly people are being exposed to that problem. If you're a renter and your rent is, the landlord might have having to refinance into a more expensive mortgage. So he's got to start pushing that down into the rents. Or you're a homeowner that didn't have the 30-year mortgage, you have the 5. So just one by one, people are getting, exposed to the cost of housing. And so that is why I think there's this constant pressure for wages to go up at like 5%. And I think there's this real, and I think also another side theme here is I think that the worker is getting a little bit more leverage and being a bit pushier about that they really want these wages because they have options. They're starting to do, all the side hustles, all the different Airbnbs, all the different ways to make money. And I think the dynamic between workers and the job has changed. And anyways, I think this is why there's a lot of catch up to go in wages and the cost of living. And that's why I think it's, we're still resetting from what happened with the housing market after COVID. And I think that's why we're not, that's why I think the Fed is getting wrong is that, trying to buy, if you were coming to the market and buy a house today at these prices with these, it's a double whammy. The price is higher and the interest rate is higher.
Right.
You still need another 30% higher on your wages, I think, to go. So that's why I think inflation is going to be persistent. And so
sorry, go ahead. I'm sorry, didn't mean to interrupt.
No, and I was just going to say that. And then the cook extra icing on the cake is if we were to get a weaker dollar or energy prices, that would just kind of be the tipping point. Because I think the markets,
and to your point about the wages, I think that's a great insight. And if we stop and think about what happened was we had COVID with the shock, a lot of people retired. So we had this kind of contraction of supply of labor because a lot of people retired earlier if they could. They were like, okay, I'm going to, I'm close anyways. It's time to retire. So we had the contraction. And then the response by governments, and in Canada, we had unfettered legal immigration, where we expanded our working pool in a huge amount because the government was panicked about there not being enough workers. In the US, I think they turned the blind eye to, illegal immigration. But either way, you had this huge influx of workers. And now in both countries, in the US, they're sending them back or whatever, or at the very least, they're not allowing anymore. Canada is also cut down. So to that point, I think we're back to that environment where you noted that the labor all of a sudden has more power.
I think so. I think there's just so much catch up to do. And I also, I think people they're not as tied. It's like if you have 4 different types of income coming in, which I think is this new model people are adapting to, where you're not a one-legged stool and you only depend on your job. I think people are evolving to this multiple income stream. And that's when you have a bit more negotiating power with your boss. You're like, no, you can stuff it. I'm not, I can go 6 months or 8 months without a job and find a new thing. I will walk out of here today.
And one of the things is if we assume that, like, if you think over the last 20, 30 years, labor as a percentage of GDP has gone down in terms of we had the fall of the Berlin Wall, of the Iron Curtain, and we had China entering the WTO. Now, all of a sudden, labor's got some, bargaining power. And so on the other side of that is corporate profits as a portion of GDP have been increasing as the labor side's going down. And just kind of simplicity, if we think about it, and we're going to reverse that trend, why are we paying record multiples for the stock market?
Yeah.
It's ugly. Point. Okay. So, but you have some solutions to this, and we're going to talk about one. No, you do. I think you do. We're talking about, but actually, before we talk about your solutions to this, I just wanted to, bring us back to one thing you mentioned there, and you talked about private equity a little bit. And when I got really bearish on private equity, I was like, and I specifically, it ended up being my way of playing for widening credit spreads was to short private equity. So far, so good. But I was thinking to myself, okay, who can I talk to that's really smart about this? I'm like, I know, Erik. And you were rightfully bullish on this for a long time. For a long time, you rode these things higher, and you were riding kind of a financialization wave. Maybe that would be fair to say, like the idea that the world was becoming more and more financialized. I'm wondering, have you changed that opinion? What's your opinion on private equity? And am I out to lunch and thinking that the really ugly part of the credit market might be sitting in those companies?
I have on the shorter term view, I think if the 10-year goes to 6, that space is going to really struggle. And you're going to finally, I think they've been doing their best to keep the car on the road and manage the move from 0% interest rates to 4% 10-year, right? And I don't know what their private companies. It's also very hard we think we can generalize it, but it's very hard to get in specifically because these are all private companies and to see really the details. So just to say that, but my sense is that they have been managing the situation so far with some stress. But I think if we get this next leg up, that particular space, leveraged private companies, is probably going to get there. We're going to finally see the markdowns that I think we thought would happen, but haven't seen much for. But I think what you were talking about is longer term. I wonder, and you feel they making, you kind of don't want to cheer for them, but I wonder if it's actually an amazing business model. And why because it reminds me of the Project Zimbabwe. What is it? Because Project Zimbabwe was the bad is good. That the terrible thing is when things start to unwind, actually, and you get higher inflation, you get more budget deficits, and all these things are happening, which you think are so terrible, but they're actually very inflationary, and the market goes up to the moon. And we've seen this in Argentina, Venezuela, Zimbabwe, and it kind of actually the bad thing is not being exposed to it. And the sad thing I saw in Africa was really that was not that the market crashed. The struggle was that most people didn't have any equities or any investments, right? So as this devaluation of currency is happening, assets are getting away from them. The whole cost of living, the market's going up, and they're not participating. And so what would the often very smart entrepreneurs would do is they would buy cash flowing businesses and then leverage them. And what I think I might have even spoken about this on last time we were talking, but one of my friends who I worked with, who was, American guy, who used to not like being levered at all, he came around to this realization that it was really not so much that the business you bought was growing and innovating and sales, the number of, it was really that nominal inflation. So whatever you were selling, the price was going up and the loan was staying constant. You were almost shorting the currency. So when I look at the private equity, I go, this is a Zimbabwe trade. What are they doing? They're buying cash flowing businesses and leveraging them up. And as long as they do it, as long as they don't get, and the problem is you can get shaken out of it, right? If you get a sharp raise in interest rates. But if you can stay in the trade, it's actually a brilliant Zimbabwe trade. And think what they're creating they've kind of created the right situation to do it, right? The problem with why you or I, if we were to leverage up a stock market position is when the volatility comes, we get a margin call and crap, on a bad day, we get taken out of the position and later on we go, oh, look, it went up and I got margined out at the bottom. They have, we all complain, oh, well, they're not marking to market, but that's the whole beauty of it. We're not going to mark to market this thing. We're going to market wherever we want. We're going to leverage it. The bank can't say anything about it because and even what's now kind of interesting is it's become so big, they've created their own ecosystem. It's almost like we don't have to IPO it either. We can just sell it to another private equity firm, right? And so we've kind of created this amazing asset. We've kind of created a way to have basically have a leveraged play on the economy with no real risk of getting margined, which you can't do with the S&P. Right. So I go to some degree, I go this, and oh, by the way, we're going to vertically integrate the whole thing. We did this with the equity piece, but then why are we giving away so much money to the banks when we do the loans? Maybe we should have the lending piece too, right? Right. I'm like, so I think there's a risk of a kind of a shakeout over the 2 years if we get this move in the interest rates, and I think people will hate private equity. But and oh, by the way, and also kind of on a cyclical basis, a lot of endowments and players have really over allocated to it. Yeah. So you've had this move where Princeton has gone from 15% private equity to 25 or 30. And so, but the game now for the private equity companies is try and get the pension funds to up their allocation. So you need a greater pool coming into this space. And I'm slightly worried that they might be successful on that. But anyways, that's why I say you're probably right. You're probably right in the shorter term, but longer term, I've thought, if they sell off, do we actually go in and buy these businesses?
Yeah. Erik, it just shows you that we are definitely not talking squiggles when you're talking about the 1 to 2 year being the shorter term.
No, I know. Sorry.
Like that's talking the time frame. Hey, listen, if you want to go do a short term trade and short these for the next year or two, I completely get it. But over totally 5 or 10 years, yeah, like that's kind of funny. All right, so let's go back to your negative on, or you're worried about the U.S. economy, the U.S. market for reasons that you've discussed. But there's other opportunities out there. And one of the ones that you have that you're most bullish on is China. And I would love for you to, tell us why you're bullish China and all the folks that are petrified about the Trump tariffs and about the ongoing problems in China and the fact that the housing has gone down so much. What are they missing, or what are they overly worried about that you think is not as big a deal?
Yeah, and I want to just hit that first part that you said, Kevin. My dad used to say, focus on your opportunities, not your problems. So yeah, that's
a good one.
The US is maybe it isn't as bad as we think, right? But let's go. It's not exciting. Let's go find the exciting things and the juicy trades and make money. And that's, to me, China is the most interesting thing out there. And I think the setup is we're kind of, some of it's starting to play out. So maybe we're in the second or third inning of this, but I think the setup is amazing. This is the second largest economy in the world, right? This isn't Mongolia, right? Or some irrelevant country. It's the second largest economy in the world. I think the stock market is 18 trillion in market cap. So it's big. You have this, basically the financial crisis of China, the GFC. China is going through their GFC. And I think back to the financial crisis of the US, right? And at the bottom, I got kind of bullish, but I didn't get bullish enough. I mean, I had a friend who was going out to the Central Valley of California and buying houses, like vacant houses from the banks, and participating at the courthouse and just bidding on everything. And I was like, whoa, man, Dave, that's super risky. What if I wish I could go back in time and do exactly what he was doing, right?
Right.
And I'm like, whoa, this is like a second chance, another bite at the apple. Here's China, massive massive crash in the stock market, not having that much of a real estate crisis in terms of non-performing loans, not anything like what the US had. GDP is still 5%, but we're acting like it's this enormous, crisis. And here we go. And oh, by the way, and all the ingredients are there. So market's down, having real estate problems, concern about the banks, government stimulating, interest rates are 1.8%. It's like, wow, this is the entire recipe for 2009, 2010 US. And we go back and we wish we could have bought the S&P at 600 or 660, right? And we're at like 6,000 now, or were. And so I look at China and I go, we should be low. I load the boat on China. And the other piece, other nuances to this are, the part I love about this is it doesn't, you talk to investors and they'll go, I don't like China. I don't agree with it. I don't want to buy it, whatever, right? And I go, the best thing about this is it doesn't matter what you think or what I think. The Chinese have enough money to run this market through the roof, whether you care or agree or not. It will
completely agree. It is. That is the part that I think everyone's focused on. They're focused on like the Trump tariffs and whether Americans are going to buy China. China doesn't need
matter.
Americans to buy it. Like
most savings of anyone on the entire planet, they have more money than. And if the government is telling them to go into the stock market and saying, oh, we don't like all this speculation in housing, we want to stabilize it, but we think it's better if the money goes into the stock market. I mean, sheesh. Yeah. This thing is a pile of wood with like gasoline poured all over it. and I would say another match on this whole thing is a lot of, according to our friend Lewis, a lot of Chinese have their money in dollars, safely parked in, and they're not even bullish on their own economy. And as the economy starts to pick up, as the market goes, they're looking at the Hang Seng index going up and the S&P going down. This money is going to start to go work its way into the market. And what I think that what China can do, like with other EMs struggle with, is it can get nutty. And the Chinese love to gamble, right? So this thing can get properly crazy. And that's what I love about it. That's how I'm like, this one, if it gets, the horse really gets the bit in its mouth, the Chinese will definitely, they will be buying options and, convertible warrants. And I mean, the whole thing will go. And I think it will, I think it will have a great year this year. But I think, again, like we talked about, I think there will be it will probably even go again next year. So yeah, I think it's a great.
Do you worry about the as our friend Shrub likes to say, the fog, fear of getting Gazpromed? And if so, do you do anything to protect yourself against that?
Yeah, in one way I should be, because Trump he put out an executive order around pension funds not investing in Chinese stocks. But on the real fear was like an invasion of Taiwan, right? Okay. And that's the Gazprom. I mean, instead of Ukraine, switch out Ukraine, China invades Taiwan, and all your assets are, same Gazprom. I feel much more comfortable that is not going to happen with Trump. I think those two guys are able to communicate, and there'll be a lot more negotiation and discussion before anything like that happens. I actually think the chance of that happening with Trump is way less. They're tough guys, both of them. And I don't think there's going to be a surprise invasion of Taiwan with Trump around.
But I guess you might say, but Trump might just offer it up as part of a deal.
Just do it anyways, right?
But then you don't get Gazprom, right?
Yeah.
If it's part of a deal, you don't get Gazprom. So really, it's just that if China goes ahead and does it without a deal is the real problem. So maybe you're right. Maybe that is not the issue. I don't think it's going to happen anyways. I never thought it was a real issue. I was just wondering what you thought.
No, yeah. So I think it's less likely, but another layer to that was China's so much bigger, so much more integrated on trade and finance that would be a real mess. And the banks themselves, like JP Morgan has business in China where it doesn't have in Russia. There's a lot of linkages to China that weren't to Russia that I think there's a lot of reasons why it wouldn't happen.
Okay. All right. I like that. Do you have any specific names that you want to talk about in terms of China, or do you just buy them all, like buy the indexes?
Yeah, maybe, people maybe just buy the FXI or some ETF. If you're, I like to do the bottom up work. I started with the tech stocks with Alibaba and Tencent and Baidu. Baidu hasn't worked out as well, but now I'm kind of I'm going into the financials, some of the stuff like the insurance company Ping On. So yeah, I'm probably should. There's probably a lot to do, and there's probably lots of smaller stocks that people don't know that can go up even more. I was just more, just
Just like
have
a
the
macro
exposure.
call,
Yeah,
true
get it,
macro
get it.
call.
And
Or
oh, sorry, I should say
yeah,
one thing I am doing. I have been buying. I bought the Hong Kong exchange and the Singapore exchange,
oh,
and so
like the
that's
actual
my
companies.
yeah.
Okay.
Yes, that's my view was
Yeah.
like, let's own the toll booth.
Yeah.
That's the guy that clips the ticket on every trade, on everything, on the on the stock market going up, on the options, on the data, on the futures, the whole. So I remember when this market went up in 2005, and I was covering them at Passport Capital, and I kept underestimating the earnings on SGX and Hong Kong Exchange. They
Okay.
were growing earnings like 30-40% a year, and I just never I was like, whoa, it was just impossible to predict. And oh, by the way, because of this business model, it's a computer software, right? It's this
Right.
exchange is a building, a bunch of offices with computer software. It's almost fixed leverage. So you get a
Right.
lot of operating leverage, and these companies generally pay out 60 to 70% of earnings as dividends. So as this thing goes mental, they just pay it all out to you. So it's a very cash flow business when it works.
All right. So for the last thing that we're going to talk about, it's probably not what people would expect, because you're even though you're a bear on the American economy, or at least concerned about it and worried about it, you are actually quite a bull on AI, and you
Oh,
have, this theory, and you call it the containerization of thought. So if you could just kind of over the next 5-10 minutes sketch out your thesis there, what you think, and whether and how people might take advantage of that.
yeah, I'm going to do a probably webinar about AI on a more personal level, but this is a macro conversation. So I'm going to bring my macro view here. I think we are being very complacent about the effect of AI on the labor market. And I know why, right? Like we look around at dishwashers, sewing machines, and kiosks at the airport, and we go, "Wow, I bet someone was worried about what this would do to jobs in the future when these things first came out." And yet here we are in the modern world with 4% unemployment and all these things, and they never ended up being a problem, right? So that's the kind of like, don't be a Luddite and fear technology. But I think there's a very interesting story about containerization, and that was going back. So this, pre 1960, kind of, you remember the old movies, and it was called break bulk shipping, and you had cargo nets and boxes and things were moved. It was very, there were pre-containers. 1960s, they come up with the idea of the 20-foot container. We should, everything's going to go in this box. That's the box, and ships are going to be designed for this box, and the cranes are not going to be cargo nets. They're going to move these 20-foot boxes. The 20-foot boxes go to these trucks that are specially set up for the containers and the trains. The whole system from Beijing to LA is set up to move 20-foot containers. And that seemed like not a very big innovation. I mean, kind of a cool thing. And wow, if you said, oh, that's going to bring, that's good for shipping, brings down the cost, right? That was the first order effect. The second order effect was, over time, companies said, wow, it's really easy to ship things. It's really easy. The contracts are super easy. The whole thing works really well. Why don't we manufacture in China? It actually works kind of well. We don't have to have this factory in Ohio. Let's unbundle our factory. And this 20-foot container idea has made manufacturing in this faraway place, which is super cheap, much more affordable. Let's do it there. And when you look back at the unemployment rate in the US, from the 1970s, early 70s, it was 3.7%, just under 4. By 1982, it's 10%. And when you go back through the economic literature, no one conflate or connects those two things. And I'm proposing a connection that I don't think I've ever seen an economic report, and it's too hard to prove. But I'm saying, I think remember the 80s when the auto workers had the sledgehammers pounding the Toyotas, and that was that that was actually a period of dysfunction and adjustment, I think, in the labor market. I think that move from 4 or 5% unemployment to 10 was companies in the US globalizing. It was the shifting of manufacturing to Asia. And you had this period where lots of people had grown up to be manufacturers. And we don't say that now. No one wakes up and goes, I'm going to work on the Ford auto. I can't wait to, work in a machine all day. Or with now they design, you're an engineer, but in the back. So the labor force took time to adjust. And then there was a period of an unemployment. And what I'm saying is this: if a 20-foot container was able to have these unexpected effects, which over a period of 10 years led to 10% unemployment, we have a thing that's living software. There's so many multiples more disruptive than the container, and in a way is unlocking a foreign land of cheap labor, as in the same way that container unlocked China. The AI is unlocking a vast labor pool of AI agents, which cost nothing. And I think we are going to find that over the next 10 years, and this or less, we're going to have much higher unemployment rates. I think it's going to take, and maybe after 10 years, eventually the new kids grow up and they become AI and, whatever, the search engine I remember having drinks at a ski resort with some mom from my kid's school, right? And I asked her what she did. She was, oh, I'm a search engine optimizer. And I was just thinking, that's such an interesting job that we never would have thought in the past existed, right? But she's just a mom with her kids and she's a search engine optimizer. And in 15 years, we'll have some version of that for AI. But in the meantime, I think it's very likely we could have this a much higher unemployment rate going higher. But my other just last thing for the viewers at home is, I think the paradox will be, going back to the Zimbabwefication, we'll probably also have 10,000 on the S&P. I think bad is good. The offset to this high unemployment will be massive deficits, weaker dollar, massive inflation, and stock market going higher.
Is there, do you think you can own the AI companies, or do you think that there's just so much froth built into those prices that there's no way to take advantage of the positive aspects that you're discussing?
No, you're going back to my weird time frames, right?
Yeah.
I kind of think, go party in Europe and go buy banks, or go party in China. China might actually benefit from this. I mean, there's a lot of good tech companies in China, but I think that's why I think if it's 2 or 3 years out, we're going to want to come back to the US, because I think the real beneficiaries are the Googles, the Amazons. That cloud business is very, is the connective. You want to, how do AIs interact? Or this is a longer thing about, I think, also a transition to the mini entrepreneur. It's more of that small businesses, and what do small businesses use to do? I mean, it's how do they advertise? How do they use AI? How do they use the cloud? All those, basically, I think we're going to come back to US tech.
Okay.
But I think there's a little bit of a shakeout.
So a little bit of your shakeout, your short-term trading is avoid it for the next year or two, and then think about it.
Remember 2000 with the internet, right? It was totally right, but there was a painful part, maybe come back in 2003, right?
Okay, got it. All right, Erik, it's always a pleasure having you on the show. Why don't you tell people about your letter, where they can find you, and how they can subscribe?
Thank you. It's your weekend reading, and the website's www.ywr.world. And I try to have conversations like this where I present contrarian ideas, macro themes, also stock ideas, and try to make it interesting for you.
And you definitely do that. And Erik, you are one of the most original, outside the box thinkers. And we were both on a trip, and I said, when we were thinking about who we were going to take, I said, I don't care who comes, just make sure Erik is there, because I want to pick his brain. And it was a real pleasure having you on that trip and getting
that trip was really fun. It was great.
Anyways, thanks again. So it's for those who want to subscribe, go check it out, and I highly recommend it. It's ywr.substack.com.
Or .world, www.ywr.world. I try to say it's like we're going to talk about the world, not just the
There
US.
we go.
So
Got it. So Erik at Your Weekend Reading YWR. Thanks a lot.
thanks, Kevin.